So I want to welcome everybody for this webinar, and I want to thank Brad. I'll introduce Brad in a minute for coordinating this, but this is one of our webinars. We were originally doing monthly, but we took a little break for the holidays. But now we're back into delivering webinars that will precede our in-person meetings for the University of Cambridge Disinformation Summit. Today we'll be talking about capital market implications of disinformation, and we're joined by two colleagues, and Brad will introduce them in a few minutes. First, I'm Alan Jagelinzer. I'm the professor of financial accounting. I co-chair the Cambridge Center for Financial Reporting and Accountability, and I'm honored to be joined by Brad Badertscher, who is the Deloitte Foundation Department Chair of Accountancy and the Professor of Accountancy at University of Notre Dame Mendoza College of Business. And Brad is also one of the facilitating advisors to this summit. So I want to appreciate his participation, and I'll hand over to him in a few minutes. Why did we do the summit? Well, we're information scientists in accounting, and we deal with disinformation in our field, and we're going to talk a lot about that today in the context of financial markets, capital markets. We've been dealing with it for a long time, but as I've seen, and we've all witnessed over the last few years, there's a proliferation of disinformation. It's not particularly new, but the channels through which it's being broadcast and the implications are far-reaching. And so we thought that we would actually bring a webinar series and in-person meetings to try to better understand this and to start working on interdisciplinary research, because often we stay within our own box within accounting and finance and economics, and we're not communicating with journalists. Typically, we're not dealing with psychologists who are working in this space. And there are a whole host of other areas, information scientists in authoritarian studies, et cetera. So we decided that we would convene and we could start working more interdisciplinary on this. I want to start too with a definition. I think every time we do disinformation topics, we should have a definition. And I credit Stephen Jolly, who's also one of our advisors for this. We're going to use, in my mind, I think it's easy to use the Canadian Center for Cybersecurity's definitions. And we'll use disinformation particularly to refer to false information that is intentional. So there's an intention to manipulate, cause damage, or guide people into actions that are in the wrong direction. Misinformation is often conflated. That's unintentional. And so this is false information that may or may not. For example, often misinformation is a result of disinformation, meaning I've received disinformation, but I don't know that it's false and I might share it accidentally. And then another definition is malinformation, which is based on some sense of truth, but it's exaggerated or utilized in a way that's misleading. And I think there's also an intention to mislead, but in this context, malinformation is with respect to actually truthful information, but utilized in a context that might be misleading. So we'll operate with those definitions, I think, which will help us in the discussions that follow. With respect to the summit, just to illustrate, we have an advisory board, and we reached across to multiple disciplines, including people with BBC and across universities, University of Zurich, Notre Dame, and other schools to support us. We will have in-person meetings in late July of 2023, and I'm honored to announce that we've commitment from Frances Hogan, who is most well-known perhaps for the Facebook whistleblowing. And so she's going to be our dinner keynote, and we have a whole host of other speakers. This is just a partial list, and the speaker list is growing. Those will be live streamed as well. And so we'll have a big affair where it will be able to access the live stream. So I'm going to hand over to Brad, who will introduce our guests for this talk, and I appreciate all of you for coming. Brad,
awesome.
Yours.
Thank you, Alan, and welcome everybody. As Alan said, this is this webinar is part of a bigger series, bigger initiative leading up to the conference here next July. And if you haven't already, I encourage you to check out the webinars on YouTube that look at the societal impact of disinformation, the methods of how it's disseminated, ways to mitigate it. And this is in that context, but we're now going to sort of look at it through the lens of accounting research. And you may ask, why accounting research in this role of disinformation? But when I think about it, we have, as accountants, have been dealing with misinformation for decades. When you think back to the Securities Act of 33 and 34, that was designed to give investors information because there were fraudulent activities going on. People were, essentially disseminating false information. So we have since then developed systems, right, in place to help us as accountants and financial markets to deal with that. And so I think there's a learning opportunity for those that aren't in that space to learn what we're doing, and also what you're doing, what other systems have been set up to help alleviate this. So we have standard setters, we have regulators, we have auditors that are help to design internal controls, and we'll talk about, I think, in this discussion here later today, providing assurance of financial information that are free from material misstatements. So we have systems set up, and so I think other areas can learn from us, as I said, and we can learn from other ones. But I think it's an exciting time in this area in particular, in accounting, to help alleviate some of these issues that we're going to talk about in a minute, as we deal with the proliferation of misinformation. So it's my pleasure to have two speakers here to talk about this that have done research in this area and want to share what they've done, and think about how we can extend this and what we can learn from it. So I want to first welcome Professor Susan Shu from Boston College. She's got her PhD from Rochester. She's interested in disinformation and social media and litigation, and has published in the top accounting and finance journals. And her paper that in particular she's going to share is called "Can Social Media Distort Price Discovery? Evidence from Merger Rumors?" And again, that's the QR code, or you can find it here in the link. It's published in JE 2020. So I'm going to have her sort of give a background of herself and this paper, and then I'm going to introduce the second speaker, Austin, and he's going to do the same about a working paper he's doing that's very related. And then we're going to come together and have a series of questions from myself and from Alan and from you, the guests here, to continue this conversation about the role of accounting and regulators and whatnot in this space to help us push this literature forward. So Susan, I will turn it over to you and welcome you, and thank you again for joining us.
Thank you. Let me share my slides. Can you see the screen? Okay. Well, I want to thank Alan and Brad for giving me this opportunity to talk about my research topic I'm really passionate about. So disinformation, but specifically, I'm going to look at disinformation from the perspective of social media. Okay. So social media, we don't need to say too much about importance of social media in today's society, right? According to a 2017 Pew Research Center, 2/3 of Americans now get some form of news from social media, right? And when we say social media, it's different from traditional media. Some of the features that come to mind include, well, it's user-generated content, the speed with which the news can get out, the reach of the news, right? And also the specific network effects, because people form different social circles on social media. Now, these unique features basically make social media an effective corporate disclosure tool. And that's where the accounting literature kind of got into the social media space, is viewing social media as a tool for dissemination. For example, companies can disseminate important corporate news on social media, right? And people have shown that in that process, by disseminating important information such as earnings, social media basically facilitates the news dissemination, and then reduces information asymmetry among different investors, increases the liquidity, okay? And in one of my other papers, we worked on sort of how social media, because of the user-generated content and the speed and the reach, it enables companies to sort of frame their own version of the narrative, and therefore able to mitigate the negative consequences associated with product crisis, specifically product recalls. So that's kind of how the accounting literature got into social media, first as a disclosure tool. Then it kind of evolved to the more general information role of social media. and the evidence has been overwhelmingly positive. So social media appears to play a fairly positive information role. For example, various papers have shown that social media helps price discovery, right? For example, if you aggregate information, okay, and because of the wisdom of the crowd, the aggregated information can help predict future earnings, sales, returns, right? So all mostly positive. Now, one thing that's a bit puzzling for us is this positive role of social media seems to be somewhat disconnected from the anecdotal evidence that often talks about sort of the dark side of social media, or the social media as a platform to spread, for example, false information, disinformation, misinformation, right? And also the SEC stance. For example, the SEC put out multiple investor alerts, okay, warning investors about stock rumors on social media, right? So this disconnect motivated basically my paper with my co-authors. We want to focus more on the sort of dark side of social media, whether social media can be a rumor mill, okay, that spreads and proliferates false information. And in that process, it distorts the price formation, and in fact would distort and delay price discovery. Okay? So that's the purpose of our study, the study I will talk about now. Now, what are the mechanisms? How would disinformation on social media translate to distorted prices, right? So we conjecture that the very features that enable social media to play a positive information role can also exacerbate investors' behavioral biases, okay? And in that process can actually distort price discovery. So some of the things that we explored or we conjectured would be limited attention, because investors have limited attention. So when the news or the story is pushed to them, they would see it and they don't have time to do their own research, and they would take it at face value, right? The other thing that's specifically relevant to social media is this academic term called persuasion bias. But to put it plainly, if we see the same information again and again, okay, we are going to attribute a higher perceived validity to this rumor. So we think, okay, it must be true because I've heard it from multiple sources now. And on social media, you can imagine, because we are connected in different circles. So if some rumor surfaces, then if I see it in this person's, then from the another acquaintances network, right? So eventually I'm going to believe this must be true, right? And that would lead investors potentially to overreact to certain news. So the paper is called "Can Social Media Distort Price Discovery? Evidence from Merger Rumors." We first needed rumors, right? For that purpose, we decided on merger rumors. Why merger rumors? Because merger rumors are quite prevalent, okay? And oftentimes they will surface and they will talk about, is Microsoft about to acquire Yelp, okay? So these are the news that will catch investors' attention. But surprisingly, these rumors are very speculative, okay? In the sense that up to 80% of these rumors will actually not materialize, meaning 80% of these merger rumors will not turn out to be a merger or an acquisition, right? They will fizzle out. We will look at a specific form of social media, Twitter. That's because the data is relatively available, okay, for Twitter, and Twitter is one of the most popular form of social media. Okay, so basically our research design is we're going to look at merger rumors, okay, that surface from media, okay. So a news outlet reports a merger rumor, okay. Then our theory goes, well, the Twitter users will see the rumor and they're going to react to this rumor and they're going to tweet about this rumor, okay. Now investors observing all these activity on Twitter would then react to the news of the merger rumor, okay. So what do we find? Our findings are very simple. We find that the highly tweeted rumors actually generate abnormal returns. So investors react more strongly to rumors that have been highly tweeted, okay. Yet the rumor-related tweet volume does not predict rumor accuracy, okay. So when we try to use a rumor-related tweet volume to predict future realization of these merger rumors, we don't see a correlation, okay. So we've put the two together and our conclusion is it seems that investors overreact to highly tweeted rumors because highly tweeted rumors are not more likely to turn out to be true, okay. Yet investors react as if they are more true, okay. So that's our first two sets of results. Then to link our evidence more explicitly to false rumors or misinformation, we looked at a subsample, meaning the rumors that are false, they did not eventually materialize, okay. But mind you, that's about 70% of the sample, 70 to 80% of the sample, right? So we now look at the price evolution for these rumors that turn out to be false later on, right? So we found that investors do overreact to highly tweeted rumors, just like the overall sample. But we also can see explicitly the price evolution after these false rumors surface. We find that the price distortion is actually prolonged for the highly tweeted rumors, and it takes up to 2 months for the reversal to occur, for the price to revert back to normal, right? So we kind of view that as a explicit evidence of price distortion because of tweets, okay? Now, certainly we drew causality. We tried to kind of say, here is the link. Rumor surfaces, Twitter users tweet, and therefore investors react to tweets, right? Now, an obvious identification challenge is the reverse causality, meaning maybe the news surfaces, investors react, and Twitter users see the price reaction and they tweet, right? So therefore, a very big challenge for us is to establish causality and try to rule out the causal link number 2, the blue one, okay? So what we did then is to look at some different settings. For example, we looked at the rumors that surface during non-trading windows, weekends, holidays, after hours, for example, right? And look at the following day's returns. We continue to see this relationship. Another thing I thought was kind of interesting is we looked at rumors that surface on days with Twitter outage, okay? So on those days, Twitter had problems with logins, for example. So on those days, right, they obviously would be lower rumor-related tweet volume, right, because of the Twitter outage. But that's not driven by anything else. It's really technical issues at Twitter. So we see that when we bring in this Twitter outage, that on those days, okay, price distortion is actually mitigated. So when there's not a lot of rumor-related tweets, the price distortion is mitigated. Okay, so our main takeaway is we provide evidence on how Twitter affects the spreading of financial rumors, and we document a dark side, right, of Twitter as an information channel, meaning the rumor mill effect can prevail when we have false information, right? Despite all these positives that have been documented in the literature about social media, we show that there's also a dark side of social media as an information channel. However, we do not study how social media affects the origination of rumors, right? So ours is very specific, is how social media plays a role in spreading the rumors. But even in that process, it actually can distort price formation and impede price discovery. Thank you so much.
Awesome. Well, thank you, Susan, for that. Look forward to coming back and talking more about some questions about the paper and your thoughts on sort of where we can take that from here. But thank you for that.
Great.
I'm going to turn it over next to Austin Moss, who's a faculty member at the University of Colorado. His PhD's from the University of Iowa, just joined Colorado, and he's doing some interesting work on fake financial news. And what I really like about his paper and why I think it's huge relevant to really give us some insight is the role of accounting information, specific accounting information, in trying to mitigate false fake news. And so we think about disinformation or fake news, it fits right in that wheelhouse. And so Austin, I'm going to turn it over to you to share your research.
All right. Thanks for that introduction, Brad. And thanks to both Alan and Brad for having put this on. It's a great opportunity to meet, hopefully, like-minded people looking at this space and share some of the ways that, research in accounting can actually be influential elsewhere. All right, so Brad gave me a little bit of an introduction, but I'm Austin. I'm a professor at the University of Colorado, Boulder. My personal research website is just austinmoss.me. You can find all of my papers there. Some other research interests that I have is, fake financial news, retail investing, and ESG information. And I think these three topics really kind of just get the fact that I'm interested in how everyday people interact with financial information and accounting information more specifically. And so the paper I'm discussing today is the role of accounting information in an era of fake news. It was co-authored with Betty Liu, who's at Indiana University. We started this project while we were PhD students at the University of Iowa. We were co-office mates, and this was right about the time that fake news started kind of, as a buzzword, started getting popular around the 2016 election. And we're just talking about, here's a real world impactful construct, and then we also, how can we research this? So think about it. And we kind of drew parallels, as Brad did, to the earnings management literature in accounting and how accounting provides information that, should be helpful in combating fake news. And that's kind of how we got to this start. I would say this paper, specifically, a one-sentence summary is that our paper explores the content, timing, and targets of fake financial news. A little more specifically, we use Seeking Alpha articles as a setting, and we identify articles as being fake using a linguistic algorithm from psycholinguistics research. We examine the content of these fake articles using an LDA topic model. We then document the timing of these fake news articles or the publication relative to earnings announcements, which are arguably one of the most impactful events in a firm's information environment and through a firm's year. And then based on some of these descriptive analyses, we propose two countervailing roles of accounting information: the information effect and the attention effect. And I'll expand on both of these in the presentation. And then we examine the validity of these effects and find evidence generally consistent with both of these roles. Overall, I think we document several stylized facts about accounting information and the role that it plays in this new era of fake news. And I think there's a lot of opportunities for future research. So corporations are targeted by fake news campaigns. This example specifically is the company Farmland Partners. they were targeted by fake news in the Seeking Alpha. And the Seeking Alpha article alleged that over 350% of farmland's earnings were fraudulent and did not exist. So this is a kind of a direct, the author of this article was directly attacking this firm's accounting information. And the company came back and went through great lengths to dispute this article, claiming that this is false and materially misleading. However, the fake news clearly still had a real impact, as the share price declined over 40% in the days following this article. Other examples include BlackRock getting targeted by a fake letter on climate change. Fake news has even caused bank runs. And I mean, the anecdotes, the examples are endless. You can just keep going. But basically, fake news is a relevant threat to these corporations. And this threat has even come into these firms' risk disclosures within their 10Ks. They discuss how fake news, they could be a target of fake news and how this would materially impact their stock prices. These strategies that have been discussed as to how you combat fake news are particularly relevant to accounting information. It's, always be transparent and maintain an up-to-date hub of information. The first, transparency, and the second, with the up-to-date information, these are both broadly suggesting that basically you need to keep your investors, in our case, or just customers more generally, stakeholders, informed about what's going on. The more informed people are, the less likely they are to believe false information. And as a primary role of accounting information, it is to inform investors. Generally speaking, we actually don't know a lot about fake news in financial markets, particularly as it pertains to accounting information and accounting disclosures. So in our paper, we're going to broadly explore the interplay between the two. I'm going to go over how we identify fake news on the Seeking Alpha platform. First, we define fake news as information written with the intent to deceive. So I think based on Alan's slides earlier, this would fall under disinformation or maybe even malinformation, depending on how you want to categorize it. To create our measure of fake news, we take over 300,000 Seeking Alpha articles. And for those of you who don't know, Seeking Alpha articles are crowdsourced investment analyses, and they are long form. If you copy and paste it from the website into a Word doc, it'd be 3 to 5 pages of text. And so this is, this contrasts with Susan's paper looking at Twitter, where it's 140, 280 characters. We take the text from the Seeking Alpha articles and input it into the LIWC textual analysis algorithm. This is a software developed by psycholinguistic researchers at the University of Texas. And this software is broader than just fake news, but one of its scores is an authenticity score. And so we use this authenticity score to basically identify whether articles are fake or not. And I will say, so this methodology is from a finance paper, Kogan et al., which has actually just been recently published. So I just wanted to, not take credit for necessarily developing this. But so how does the algorithm decide the authenticity score? Relies on the tendencies for people to make certain language choices when they are being deceitful. For example, people use fewer self-reference words, less insightful words, and less specific timing words. So rather than saying last quarter, they might say previously, or just very generic word choices. This authenticity score has gone from a scale of 0 to 100. And Kogan et al. Have a sample of about 600 known to be fake articles. So they use this algorithm basically to decide, where should we place these cutoffs for identifying fake news? Based on this, we're able to identify about 160,000 articles as non-fake, about 110,000, so quite a large group. In the middle ground, we can't say, and 5,000 are deemed to be fake, likely fake. This classification methodology in general is quite conservative. The type 1 error rate of classifying a non-fake article as being fake is less than 1%. So the ones that we actually classify as fake, we're pretty certain that that is true. The type 2 error rate's a little higher, but these low error rates are possible because we do not include that middle section. So it's kind of one negative of this methodology. So for some personal, this is all using textual analysis. These are all ex ante expectations of documenting fake news. So we actually don't see whether these articles are fake or not true in the future. It's all based on their word choices. And so for personal validation, I actually used to write for Seeking Alpha. And this was way before I was in the PhD program undergrad. So I went back and looked at my articles. And so 2 of them were unclassified, but the majority of my articles were non-fake, which was helpful, at least with me personally validating, because I wrote those articles truthfully, or so it at least did a good job for my stuff. So results quickly. We use LDA analysis to find these topics, and we find that a significant proportion of fake articles contain accounting content. Other topics, there's about 30 topics in general. These topics include global markets, the macroeconomy, and there are many topics about specific industries. When we look at the percentage of articles within topics, so the percentage of articles that are fake, the two of the 30 topics that we identify as accounting have the lowest percentage of fake news, suggesting that it's hard to write about accounting in a fake way. Which kind of comes back to this idea that accounting can deter fake news. High fake news topics, on the other hand, include the healthcare and pharmaceutical industries, legal issues, and capital raises, all areas that are a little bit more uncertain, and you can reasonably believe that it's easier to deceive someone within these kinds of topics. This figure on the screen shows the number of fake articles in our sample over our sample period. And note that for the 2018 on the far right, it only includes the first 3 months, and that it's actually on track to be to surpass the 2017 level. So this kind of backs up the idea of fake news being an increasing threat to the financial markets. And then we're going to look at the timing of fake articles around earnings announcements, which, as I described earlier, is one of the most important information revealing events throughout a firm's year. And 2 patterns emerge. 1, there's a huge increase in fake news around earnings announcements. And 2, there's a relatively higher increase before earnings announcements than after. In this, kind of based on these descriptive analyses, we propose these 2 effects of accounting information: the attention effect, which, particularly with earnings announcements, increases the incentive to write fake news because there's more eyeballs seeking information, and the information effect, where in general accounting information informs investors and should deter fake news. Specifically around earnings announcements, the days immediately before earnings is some of the most uncertain periods of a firm's information environment, because everyone's speculating about the future, and the most recent there's stale information, which relates back to the keeping up to date. But right after an earnings announcement, there's new information, and it is relatively up to date. However, we wanted to know what this looks like generally, and so we use non-fake articles as a counterfactual to see what kind is going on. The general trends that we saw, and I would say this non-fake articles also help control for the attention effect. So we want to dig deeper into the information effect. There is a spike around earnings announcements for non-fake articles, but this spike occurs in the post period where they are analyzing the numbers. And so we infer that fake news authors are shifting their publication to the pre-period and away from the post-period. However, whether there's an overall decrease in fake news around this period is a little dependent on our test specifications, which I'll leave for you to explore a little bit further. And for that reason, we want to better understand whether the information effect actually decreases the amount of fake news. So we explore two qualities of a firm's accounting information environment. The first is the number of management forecasts they provide, which is basically how much information the firm is providing about the future expectations. And we find that there's less fake news written about firms who provide more information about the future. And when we look at the impact of management forecasts on the market reaction to fake news, we find that the market reacts less to these articles. And then we also look at 10K readability, or how easy it is to understand a firm's accounting information, finding similar results that it seems to decrease the targeting of fake news as well as the market impact. Overall, financial fake news is increasing in recent years. The impact of accounting on fake news is actually more complex than might be expected. Earnings announcements have two opposing effects on fake news. First, the earnings announcement attention incentivizes fake news publication, but the information conveyed disincentivizes fake news publication. Then we also find that firms provide more information about the future or have easier to understand accounting information disclosures are less likely to be targeted by fake news authors. And when these firms are targeted, the fake news is less impactful. Overall, I think there's a lot of insights that I couldn't cover in this presentation, and certainly ideas for future research as well. So thank you. Thank you again.
Awesome. Well, thank you, Oz, for that. I have a couple follow-up questions for both of the speakers, and then a broader question. Then I'll turn over to Alan, and I think he's going to ask some questions that are coming in the chat box. So again, I encourage you to submit your questions in the chat box. So Austin, these authors are known, right? So you could classify the authors of these articles. You mentioned yourself was an author, right? But you have data on whether you view someone as a fake author, I'll say, right? That you explore any of that in there, and can that be utilized somehow?
Yeah, we actually haven't explored kind of the persistence of a author's fakeness.
Yeah.
But I think that there is some work in Dyers and Kim where they look at whether these authors on Seeking Alpha are anonymous, so whether they include their name, Austin Moss, or whether they come up with some pseudonym. And so that's kind of related, but no, we haven't specifically looked at fake news. But yeah, that's certainly an interesting. That's another kind of idea maybe future research could explore.
So, and Susan, on yours, can you speak to any other rumors you considered looking at? I mean, you look at these M&A, but did you start with more and then you narrowed it down, or would you suggest any that you've thought of that others could think about?
Yeah, we actually, because when we wanted to tackle this question, we thought about other, there are all kinds of corporate rumors, right? Like, for example, rumors about product launching, right? Rumors about management turnover. So there are all sorts of rumors, and we just wanted to have a sample that's relatively homogeneous and that's relatively well understood. And then so we can kind of, so it just makes it a little more tractable for us. But certainly there are lots of other corporate, I would say lots of corporate rumors that I wouldn't say this is unique. Our setting shouldn't be unique.
I mean, can you each speak to some, I guess, future opportunities that you're either thinking about or that, you've come across as you've done this to think where the future research could go? And then at the same time, given your experience in this space, and we've dealt with editors and reviewers, what are the headwinds that you've faced in trying to publish in this space? So either one of those or in conjunction would be great.
Okay, so I think the opportunities in this area, I mean, this is really, I would say the social media, because it's such it's a relatively new thing, and it is obviously, it impacts all aspects of our social lives. So I think the exciting thing is there are lots of things we can explore, right? And opportunities I was thinking about, if we think about accounting research, we started with sort of using social media as a disclosure channel, right? There you can see the literature has mostly focused on the positives, but certainly you can see companies can potentially use the sort of the corporate disclosure channel, this specific channel, to disseminate very strategically, for example, right? So some people explore that aspect. And other things I should say that, for example, how social media, information on social media would impact corporate decision making. That is something that would be interesting to examine as well, and that's relatively unexplored. And the other thing is how social media changed media. That's something I've been thinking about as well, because of the rise of social media. That probably has changed the production function for media as well, in terms of how they generate news, right? And because their advertising revenue dries up, so things have now changed, right? Sort of the interaction between these two information channels will be really interesting to look at, I think.
Well, that is, I actually often think about headline grabbers and how that has changed, or how that's influenced, and how social media plays a role in headline grabbers. So I think it seems to be the generator of tweets and forwards and sharing. So
right. So one thing I was thinking about was that basically social media, because the race to get some stories out, then some newspapers, for example, they would forego some of the traditional verification steps. So therefore, you might see more news, more timely news, but maybe more sort of misinformation, maybe not intended, but then misinformation in that process.
Also, do you have anything to add in terms of opportunities, or we can switch?
Yeah, so I think I agree. I think I've been thinking a lot about how social media, I think it is a very promising space for fake news research. But I think that also speaks to the pitfalls in that fake news is extremely difficult to identify, specifically or particularly systematically. And so, there's some method, like, so the LIWC algorithm that I use in the Seeking Alpha paper wouldn't work well when it only has 140 characters of text to be based off of. So I think that's definitely an opportunity, but also a huge challenge in our going forward in this area of research. However, I will say that there are some increasingly complex and accurate, or more accurate, classification algorithms for, this is a huge literature in computer science and informatics, generally speaking. And actually, one of the MacArthur Grant Genius Award winners this past year is known for creating algorithms that detect fake news. So I think there's definitely a lot of opportunities, but pitfalls in this space. And then I'll also say the classification methodology really needs to be tailored to the specific setting that you're using. You have to know the details of the setting very well and tailor it to that. And then I would also say, from the review process and just as a reader's perspective, you need to provide some descriptive evidence on what the fake news you're capturing is actually picking up. Nobody likes it when you have like this black box and are unsure as to what's going on. And so I think that's why, in our paper, we go through this LDA analysis and some other textual descriptive statistics to try to provide some evidence on this black box. And I think that's a necessary step in research going forward. And then also just opportunities elsewhere. I would this is more of a, not a specific opportunity, but just read widely. I think accounting, finance, and even economics is behind on a lot of this area of research. And I think some literatures to look at are political science, communication, computational social science. These are all fields that I've witnessed as being kind of ahead of the game in their methods, their settings, their creativity, in all of this such. And then some specific settings that I think there's potential for research. There's one specifically is this Twitter Birdwatch program. So on Twitter, they introduced, well, it's called Birdwatch, but it's basically a crowdsourced fake news identification or along those lines. And so, and Twitter makes that data available. And so I think that's one opportunity for, what types of financial tweets are being flagged as fake by, the crowd.
Also, before I turn over to Alan here, you also mentioned doing ESG research, right? So, at the conference, we're going to have, topics on greenwashing. And so it seems like there's another opportunity to, in that space, right? The role of misinformation in the ESG space, I assume, is going to be heating up if it hasn't already, right? In terms of research.
Exactly. Yeah. I've seen a couple of papers come across recently that look at greenwashing. And at least when I see greenwashing, I immediately jump to fake news. That is studying fake news. But I don't think, at least when I've skimmed these papers, they don't really make that connection as distinctly as I might. And so that might be an opportunity as well for people in that space.
Right. I'm going to turn over to Alan because we've got some really good questions in the chat box. So Alan, take it away.
Yeah, I want to thank you both and thank you, the audience, for submitting these questions. I'm going to sort of combine Charles and Brett's together because I had the same questions. So for both of you, can you speak a little bit to the intentionality of what you're seeing, and also what would be the incentives if it's intentional? Who's winning in trying to push this stuff forward in fake space?
So in my paper, so I would say it's more, according to your definition, more misinformation. So I don't know whether there's any intention to manipulate. But it might go back to the incentives to sensationalize, right? So oftentimes people publish these misinformation because they want to attract the attention. Okay. Now, if something that's more unexpected, you probably can attract more attention. So more likes, more follows. So if you care about your social media standing, for example, you might want to post something that's really sensational, which by definition is probably less likely, because something that seems very reasonable and likely might not be as attention grabbing, right? So it could go back to basically either the poster's desire to post something that's attention grabbing.
Austin, what about yours? Because yours sounded to me as if it were more intentional and it was purposely trying to mislead. And if so,
yeah, I mean, I think
particularly
by
prior to
kind of definition of the algorithm we use, it has to be intentional.
And so I guess the question then is, what's the benefit, and also what are you learning about the users? Because I always thought,
sorry, you broke out. My internet is a little unstable.
Okay, sorry. Yeah, I'll rephrase the question. So I guess, if it's intentional, what's the benefit, and what does that mean about the users? Like, how are they internalizing this information? Because I've always had this assumption in my mind that people who are in the financial space are inherently sophisticated. They know how to read our data. So what does that say about us as the user?
Yeah, I think there's a couple things. So first, the incentive, I think, is profiting off of these opportunities. Just recently, with Elon's takeover of Twitter, he introduced this blue check verification method, and there were several accounts that basically pretended to be Lockheed Martin or Eli Lilly and tweeted out, we're giving out free insulin, and the stock price subsequently dropped. So it wouldn't, if you have that intention, it's not hard to short the stock ahead of time, tweet out, or produce fake news and then profit off of that. And about the sophistication of the people consuming financial news, I think that speaks to a couple of things. First, I guess there's 2 points I want to make. First, there's a growing amount of automated trading, algorithmic investors who are constantly and automatically scraping the web. And so to the extent that these algorithms that these broker or hedge funds employ, to the extent that they can't discern fake news or they react too fastly to the text, then that could be who's reacting to these things. And then also in financial markets, just due to market efficiency, even a truthful analysis, like there's so much, such a low or high noise signal, low signal to noise ratio, that it's really hard to discern who is being truthful or who's trying to be deceitful, just because, I could be I have a truthful analysis and be wrong 5 out of 10 times, and that would just be the nature of markets. And so I think it's not necessarily that people are unsophisticated, it's just the nature of what we research.
I have a follow-up question, I think related, and that has to do with the reputation. I think, Susan, in your paper, you looked at the influential tweeters that could impact this. And is there any sort of reputational disadvantage of tweeting things that turn out to be ex post wrong? Have you sort of followed or looked at the role of the influential tweeter?
That's a great question. That's something that we haven't looked at. I don't know how would we tackle that. That's a really interesting perspective about reputation building on social media. Whether you actually can build reputation on social media. I'm not sure. In our paper, one of the cross-sectional tests we did, as Brad alluded to, we looked at the influence, like the distortion, the price distortion. And one of the things that would exacerbate price distortion was if there are more influential people tweeting, influential tweeters tweeting about a rumor, and that would exacerbate the price distortion. So that's something that might be related, but not entirely. Yeah, so this is something that's a bit more, I would say, up in the air. And I'm also wondering whether in Twitter space, given 140 words, right, I'm not sure whether that's the most powerful setting to study reputation building. Perhaps, the other setting with Seeking Alpha would be maybe a more natural place to study the effect of reputation building.
Mm-hmm. It kind of goes back to my question earlier to Austin, is like, who are the authors, and do they have some reputation follows them, or, are they anonymous, or how does that work? So I think there's some research to be in that space about the influential, the truth building or the reputation of doing this, right? Whether it's, misinformation or disinformation. So.
I think too, if someone goes after or looks into this reputation space, it might not be the association that we think it should be, because of this low signal to noise, someone could build a reputation most of the time, but then 1 out of 10 times create a fake article, which they profit significantly off of. And so I guess the whole point is reputation might be a double-edged sword in this case, due to the setting in which we study.
That's a good point. So another follow-up question from Leonardo is, did you factor in for whether the signals that you're seeing were bullish or bearish? Does the sign of the suggested news that this is a really positive thing or a pending doom scenario, does that matter? And did you look at that? And that's for either of you.
Yeah, we did not look at that in our paper. And that kind of was this Kogan et al. Paper that came before us. Basically suggested it's difficult to look at tone in some of these texts. It's not.
Yeah. So always it's hard to say whether it's positive or negative. Sort of the tweeter when they're just talking about the rumor. So we did not study the sentiment of the tweets per se.
Great. A couple more questions. So, and this is one that I was thinking about as well, from James about short sellers, right? So short sellers' job really is to sort of put out some provocative, maybe, you know, accusation against a firm or something is happening, right? And so how do we think about disentangling that from legitimate, it turns out to be truth, right? Is there a way for us to, I mean, you're going to expose, you're going to verify, or you're going to use an algorithm, but is there any way that you could think about helping disentangle what turns out to be versus, you know, what actually is true, but it takes a while for us to figure out that it is truth, right? And it sounds fake. So, and that's what short sellers seem to be doing, right? And that's part of their job. So is there a way to sort of legitimize the you know, the news? Or
So I think there's one way that I've thought about doing it, and this is more suitable for small samples, which the big short selling research firms would be probably a small enough sample to do this for, is to actually read the report, figure out what claims they're making, and then see within, you know, a year or two or some time frame whether those claims ended up becoming factual or not. That methodology is, you know, there's some human error and stuff in that, but I think that would be one of the best ways to look at that. And it's difficult to do in a much larger setting, but I think the short selling setting would actually be a good place for that.
Yeah.
Susan, did you have a follow-up or no?
Yeah, so in our paper, because I think one of the I thought advantages of our setting is we can see the outcome. Basically, there were all these rumors, but we know which ones ended up being true, which ones ended up being false based on the eventual outcomes. I know it's not entirely accurate, but there's some sort of benchmark to kind of put them into the two different buckets, right? But certainly short sellers, I suppose this is something they can easily exploit, right? So they can drum up sort of all the overreaction, and later on, you know, knowing that the price will revert back to the pre-rumor level, right? They can certainly take advantage of that too. I mean, this is not something that we studied, but it's actually really fascinating.
Cool. Well, we have another question. Actually, this is not surprising. Can you build a risk prediction model and predict the probability of bad outcomes? And how much is, I'm going to ask, how much are you going to sell that model for to a hedge fund?
That's for Austin to sell.
He's working on that, huh?
Yeah. I guess predict what bad outcomes are you talking about? Just predict
this one's
fake news, or
it's building a risk model to assess the probability of negative effects from fake news. So I assume it's a price crash or something.
who's susceptible to fake news, or yeah, I mean, I think our paper speaks to that. You know, those that are more transparent, provide more information, are less susceptible. But I think there's, you know, if you think more broadly about risk factors, you might consider the types of customers they have. People that are retail facing, such as Starbucks, Target, are susceptible to different types of news that could alienate customers. Yeah, I mean, I think it could be done, but I think there's a lot of different possibilities to think about.
I've got one more about, maybe you mentioned retail, but I'm talking about the trader. Is there a notion that this algorithmic trader is doing this versus the retail traders? Any insight into who is falling for the fakeness? In your case, Austin, or in the rumor mill, is there any data on looking at who is ultimately trading on it? Can you link that somehow?
Yeah, so my paper doesn't look specifically at that, but the Kogan et al. Paper that we use the same methodology, they do look at whether retail investors are reacting to this and find that they are reacting to fake news. Yeah.
Awesome.
And certainly in my paper, we have a cross-sectional task that shows the companies that have more retail investors are the ones that experience more of that distorted price discovery.
Oh, that's great. I want to thank both of you for this great conversation. Thank you for joining us, and I know people can reach you if needed, and also your paper is out online here if they want to read more. I also want to make a short plug. You know, as part of this conference, we're going to be soliciting papers for the JFR research outlet so that we can publish in this space. And so not as part of the initial conference, but subsequent, we like to hear from you. So as you start to think about ideas and write research papers, please consider submitting them to the JFR. We'll have more information about that as the conference approaches, but we want to publish in this space. We want to get this research out there. And so we'll have avenues to do that. So we hope that you'll consider that. Alan, is there anything else? Otherwise, pleasure to.
So yeah, I want to just to follow up on that briefly. I want to thank everybody for attending, and I also want to say that the entire purpose of this entire series is to get cross-discipline collaboration, interdiscipline collaboration, so that we can actually enhance our research and expand it. And Austin, you even spoke to the ability to borrow from and work with other disciplines, and so that's the whole point of this. And the Journal of Financial Reporting is going to publish some work in this, and Brad's going to be the guest editor to support that as one of the potential outlets. Thank you very much for your time. Thank you, Brad, for hosting this. And we will have more of these webinars, and we will include interdisciplinary research in more. And if you want to learn about them, we'll post them on our website. We will also, if you want, you can follow my Twitter. As long as Twitter stays alive, I'm at Jagalinzer. And or we have a LinkedIn page on the Cambridge Disinformation Summit. If you search in LinkedIn, you can follow that, and we post a bunch of information there. And that's also designed to help us collaborate. Last comment, I'm working on finding a place where we can actually start doing more research discussion in sort of a blogosphere so that we can share ideas in real time and load links and share that. And I have to source that. But thank you, Susan. Thank you, Austin. Thank you, Brad. Thank you, everybody, for attending. And we'll close out tonight here in England anyway.
Thank you so much.
Thanks, everybody.
Thanks, everybody.
Thank you.
Stay
Appreciate
well.
it. Bye.